Hi, I hope this finds you safe and doing well during these crazy coronavirus times that we are living in. It's a chilly April day here, kind of weird out. It's sunny and nice looking out one minute and then sideways snow blizzard the next. Just some patchy stuff running through here today. But a couple of days ago, I had an opportunity to host a client webinar with the CEO and the Chief Investment Officer of a very successful advisory firm out of Boston, Massachusetts. They, at last count, manage roughly $2 billion in client assets. And what I thought I'd do today is actually make that call available to you in an effort to help provide some clarity into everything that's going on out there in the world. So what I'll do is I'll cue up the intro here, and then right after the intro, you'll be taken directly into that call. So again, I hope that this content helps to provide some clarity again into this kind of crazy world that we find ourselves in today. Hi, this is Eric Hagan. Would you like to know the secret to prosperity? Well, the good news is I have the answer. The bad news is it's not any one thing. The secret to prosperity is in every decision you make. The Bible calls it steady plotting. I call it common sense. Join me on this podcast as I try to inspire you to make your next financial decision and the one after that a good one. Well, hello, everyone. Welcome to today's call. We've got some more people here still filtering in, but we're at the top of the hour, so let's go ahead and get started. I'm so glad that you all are here today as we continue to experience uncertainty in the markets and in the economy. I wanted to set aside some time here in an effort to keep you informed as we navigate this fluid situation. We have both existing clients on the call today, as well as some people who are maybe checking us out for the first time. For those of you who are an existing client, I want to really commend you for taking some time out to get more clarity into what's happening out there. For those of you who I have not had a chance to meet yet, my name is Eric Hagan. I am a small business owner, president, and senior wealth manager here with Capital Consulting Group. We are a full-service wealth management firm located here in the Twin Cities area. We serve people all across Minnesota as well as all across the country. We primarily help our clients do two things. We help them see their financial future through our personal wealth planning services. And number two, we give our clients' life savings the attention it deserves through our fiduciary investment management solutions. To learn more about either of these, I invite you to visit our website at www.investwithccg.com. You know, there's an old adage that the stock market goes up a staircase and down out the window. And this has never been more true than during the recent pullback. It is incredible to think how different the markets are from just a short few weeks ago. So with everything going on, I thought it would be good to make this call available to all of you. Having been in this industry a while now, I've made some great connections and valuable relationships throughout this industry. And that being said, today you all have an opportunity that you'd be hard-pressed to find anywhere else. Today on the line for you, I have the CEO and the Chief Investment Officer of W.E.Donoghue. They are a registered investment advisor out of Boston, Massachusetts. At last count, they manage more than $2 billion in client assets across their Power Series and their global tactical suite of investment solutions. Liz, you can go ahead to the next slide there. To start us off today, we will hear from Donoghue's award-winning Chief Investment Officer, John Forlines III. In addition to his responsibilities as portfolio manager, John is also a professor at Duke University, where he teaches behavioral finance. Previously, John spent 16 years with JP Morgan, serving various roles. When John is done, you're going to hear from Jeff Thompson. Jeff is CEO of Donoghue and has been a portfolio manager since 1999. Jeff is the real brains behind the rules-based solutions that many of you are aware of. And so again, this is just a great opportunity. I'm so glad that you all are here on this call. When John and Jeff are done, there are a few questions that were submitted for them that I will present to them. If you would like John or Jeff to answer a question today, please email me directly and I will ask it for you at the end. My email, of course, is eric@investwithccg.com. Donoghue has been a great supporter of all of us here at CCG, including helping make our client appreciation boat cruise on Lake Minnetonka such a wonderful event to look forward to. I'm very pleased to be able to have them with us here today. With that, John is going to start us off by focusing more on kind of the macro environment And then Jeff is going to talk about portfolio positioning. John and Jeff, thank you both very much for your time and insight today. I will go ahead and hand it over to you.
Okay, Eric, thanks so much for the introduction, and thank you for having us on. As Eric mentioned, I'm John Forlines, the Chief Investment Officer here at W.E.Donoghue. Liz, go ahead and start us off the next slide. So what I'm going to try to do is essentially help you frame what we believe is the narrative that's going on here. And as Eric mentioned, we had a tremendous market crash, but before that, we had very good economic conditions going into the market crash, and we've had two, what I would call, one exogenous event, that is an outside event to markets, and that's the virus to deal with, and then one that's sort of internal, that's actually usually pretty good, and that's an oil price crash, usually good for almost everyone, consumers, transportation, etc. But let's focus first on the virus. We've heard about flattening the curve. That's the real key to getting the economy back open. And so there's you can see the real secret for reopening is once the infection rates are slowed and once the rate of deaths are slowed, then that typically spirals back down, as you've seen in places like South Korea and China, and even Italy has now reached a peak both on death and new cases, which is the worst per capita spot. But that's what we need, and that's why there's so much emphasis on social distancing and getting apart, so that we can essentially stamp out the rate of infections. Okay, next slide. So what's unprecedented? Because almost every recession, almost every downturn, every market crash is a little bit different. And this one is probably more, and we'll get into this in a minute, it's more event-driven, but there's a special piece of the event-driven that didn't exist before, and that is the economy is totally closed. Even when you had 9/11, even when you had the 87 one-day stock market crash, the economies weren't closed, even during the internet crash. So that does make a big difference, and that's why I think you see so much, initially you saw so much fear and panic, is that not only was there a lot of uncertainty about your own social distancing and behaviors, but there was a tremendous amount of fear, and of course about things like unemployment, and although these are for sure short-term effects, it doesn't help the fact that nothing really is open, and that is again, we haven't been through that. And what I mentioned earlier is it was one thing to start off with a sort of pandemic conditions to strike the fear in people's hearts and minds, and also their investing strategies. But the knock-on effect of having an oil price shock right downward, which was really a big piece of the uncertainty that was injected, and that came right along time the second piece of the market crash happened, which is late February, early March. Go ahead. Now, there's kind of good news and bad news in the next two, but mostly good news, I think, and that is when bear markets start really quickly, they typically don't last long. And it's generally because there's just an incredible amount of uncertainty injected in the market, and of course we have that. So historically, when you have where we had rich equity valuations, or at least historically rich equity valuations coming into the year, it was natural that you'd have one eventually, and we were all expecting that to happen. But this one happened extraordinarily fast. In fact, the fastest ever in history. If you turn to the next slide, Liz. It was not confined just to equities. What was amazing about this is you had elements of 2008, i.e. a short-term couple-day liquidity crisis when even bonds were being sold off. All the safe havens were even both sold off, like gold. And typically commodities do well. Of course, that they didn't do well because of the the oil shock. All those things sort of, it's almost like a perfect storm, but a very short-term perfect storm where you had a tremendous indiscriminate sell-off. Next slide. Now, so what happens is, and this is from not only from just a market standpoint, but from behavioral standpoint, is that it's really difficult to look at the bigger picture when you have so many bad things happening all at once. But and that's what most people did. They looked at the chart on the right side and saw, gee, the market's just completely fallen apart. But then if you look back, and the chart on the left is the one that goes back to the the 60s, is that we've had these bumps before, and we've had them worse. But what typically happens in behavior is people tend to concentrate on the last thing that's happened and really give it a lot of credence, that i.e. it'll be the worst ever. And that's typically not the case. What we have noticed in the last, say, 20, 25 years is there's been more of these very sharp sell-offs, but then there's been the opportunity to recoup, and that's what's really important about taking a look at the long term. If you have panics during the short term, then typically you lead to long-term pain. Either you'll stay out of the market too long if you decided to sell, you took tax consequences, etc. But if you had the as Eric kind of kicked this off, if you've got good leadership like Eric's group provides through his portfolio management, then you should be able to survive short-term pain, so you won't have long-term pain. And the next slide just shows what's going on is that people get even further panicked by things that are in the media, and most of the programs that people watch are advertising based, and therefore they feed on things like fear and greed, etc. And that drives everyone else to sort of be crazy. And the other phenomenon we've had, and this is post, started really with the last crash back in 2008. The smartphone was invented in 2006, and you suddenly have had a tremendous amount of what I call the multiplier effect of fear, where someone sees something that frightens them, and then they post it, and then suddenly a bunch of their friends see it, and then a bunch of those friends see it, and suddenly you can see how it can multiply. It's a dangerous loop, and it's also explains how fast things can fall in such a short time. Okay. But again, taking the longest view is the hardest, but it's really the necessary task. And so that's why we spend time with folks like Eric on longer term strategies that that do manage risk for clients, so they don't have to think about it. Because our view is that typically, I mean not typically, but almost always, the common perception, which is promulgated by most of the media, is that the world is ending. It's different, and that never really is the case. Here's all the times where when 1987, for example, it was the Time magazine called it the end of equities, basically. And then you can see over time how these do influence decision-making ability if you're paying too much attention to them. And then that's really why you need advisors, because typically, and if you look at all the statistics where individuals try to do this themselves, it's extremely difficult, because you do have these emotional constructs built in. You do get afraid, and you need folks to build diversified portfolios over time for you, because most individual investors, when they try to do it themselves, end up in that cycle of sort of despair where they can't stay into their plan, and they tend to sell out. And that's why if you look at statistics from all the retail sites like Schwab and Vanguard and all that, the average investor actually does quite poorly over a long period of time, and that's what advisors are here to help for. Part of that psychological dimension that I already mentioned is that there's a perception that when markets decline, that people have lost money. You've heard that phrase, well, I lost so much in the stock market today. But the fact is that's false on two counts. One, you didn't lose if you didn't sell. And besides, a decline is just that. A decline can be followed by an incline. It's exactly what we're seeing, short term, even right now, is that no one's lost any money if you didn't sell. However, the reason people feel like that is because the way humans tend to perceive losses. And when they do create losses themselves by insisting upon going to cash or things like that, the after effect is even worse. So that kind of gets to the point about what is really going on. Eric mentioned at the top is we're here to try to help that, and I guess the best way to explain it is try to use as many long-term multiple data points as you can, instead of saying, look, this is like this or this is like that, or particular crash or market event. Look at a bunch of them, and that's what we've done here on this chart, which is if you look at the bear market we're in, there are three typical kinds that we have. One many of us recently experienced back in 2008, which is a structural bear market where you have systems are on the verge of collapse, banking system in particular. And those tend to be very large average declines of 60% or more, and they last longer, as you see for the middle chart, and the recovery time is longer. And that's not what we're in. And the more typical one is the one we sort of all grew up with, which was, prices and wages go up, and then the central banks raise interest rates, and then there's to fight off inflation, and then we go into a little recession, and that's a cyclical or business type cyclical bear market. And then there's the one that we're in, which is event driven, and it's the shortest typically of them all. It has the shortest, the smallest average decline, the smallest average length, and one of the best recovery times right there with cyclical. And so what we all need to understand is that's what we're in. It's totally event driven. We weren't, unlike 2008, in a nasty recession just the year before 2008. And therefore, the hope that we can recover relatively quickly is a decent one. I mean, it's one that you should understand is probable. And that's why I think learning the difference between these bear markets over a long period of time is worth looking at. And then, you never want to make predictions about whether the worst is already priced in, but one of the hints I have is that, that if you look back again and compare it to what kind of recession usually results from a price decline like this and from an economic dislocation like it is, it's likely that this is going to be relatively short. Now, that doesn't mean it won't be painful. Anytime you actually close an economy, the restart is more like fits and starts as opposed to just an absolute restart. There's many things that have to be done, not the least of which we have to make sure that there's not a second wave of infections once we all, or most of us, try to get back into the workforce. So that gets us to sort of the house view. A lot of words on this chart, on this table, but the bottom line is that we're in the firm speaking, broadly speaking, is in defensive mode, and there's two reasons for that. One is Jeff's going to get into this, but we have two types of strategies that we offer clients. We offer rules-based solutions, which typically are driven by volatility in the market, where they'll go defensive on behalf of clients. And then there's the GT solutions, which are essentially trying to look very closely at financial conditions and essentially keep clients out of bear market effects in either pre or during recession. And that's what we're trying to do here. And so one of the things you'll see when Jeff describes the portfolios is we're probably in our largest cash position since 2008, which was appropriate because that's what we did back then and it worked pretty well. And the key is trying to figure out when we can go back in and try to participate in that recovery that I just mentioned. Okay, I'm going to turn it over to Jeff, and again, I'll be back for questioning at the end.
Well, thank you very much, John, and thank you, Eric, for putting the call together today, as well as your team. Clearly, we are facing difficult times. One of the things I will say is we have put our continuity plan into effect. Our firm has everybody working out of their homes, whether it be from a trading perspective to some of our relationship folks out in the field. We have grounded everybody, and we have done so for about 30 days now. So, and this is business as usual for us. Working from home, we have all the capabilities. So I want to set everybody at ease that, and this is no different here from a big snowstorm that we have in the winter, similar to Minnesota. Up in Boston, obviously we have big snowstorms where folks are working from home. So rest at ease. We're still at the wheel. So in addition to that, I would say that, not only are we seeing our world a little bit rocky in terms of economically speaking, financially speaking, but individually, personally speaking, working out of the house for 30 days gets me a little stir crazy. But we have one of our business partners here just lost his mother on Sunday. I also have a business colleague who is literally at the hospital today delivering a newborn. So there's challenges, obviously, that folks are facing in addition to economic times, which our thoughts and prayers are out there for those who are challenged during this difficult time. So with that, from an investment perspective, what we try to do is to deliver discipline with our solutions that we offer. As John mentioned, we do offer a couple different types of strategies, which I will get into, but we really want to bring our discipline in during this time of chaos. So it wasn't too long ago that we were just looking at the longest bull market in history, and which was a pretty incredible run off of the March of 2009 bottom. With dividends, we saw over a 500% total return out of the S&P 500 index, which is pretty dramatic. Relative to our last bear market or bull market cycle, I should say, we had a total return of about 120%. So we've had a pretty significant run. One of the things that I like to point out on this chart is, since the turn of the millennium, we've had two pretty significant bear markets. Most of the folks on the call will recollect that we had the technology tech wreck in the early 2000s. We also had the financial crisis, which now we're looking back 12 years or so now, which it's hard to imagine that much time has gone by. So we as a firm, and I personally as a portfolio manager at W.E.Donoghue, have been through these cycles in the past. This would be the third bear market. And although this one's a little bit different, as John mentioned, this is where discipline needs to take hold. Next slide, please. So I just wanted to touch upon our positioning, and I know many of the folks on the call are utilizing some of our rules-based signal products. And just to give you a sense of where we're currently positioning, and just to recap or refresh how the solutions work, I will start with our Power Dividend Index. Our Power Dividend Index is a high dividend paying index, which essentially starts with the universe of large cap and mid cap stocks. It equal weights amongst the 10 sectors, such as energy, healthcare, X-REITs, and it will, on an annual basis, seek the highest yielders, and we will also apply tactical overlays to mitigate downside risk. So we do have two tactical overlays that we apply to this particular strategy, one being an exponential moving average crossover. And I know that sounds pretty technical in layman's terms. What we're really looking at is a 3 to 6 month trend of the underlying index. The second indicator is a fundamental indicator, although it is a quantitatively driven indicator that we apply to it as well, has not triggered yet. So we have sold out of half of the assets and half of the dividend paying stocks and repositioned towards short-term treasuries. So we are in a defensive position. It is possible that in the coming weeks that we could be fully defensive should we see the other trigger kick in and things deteriorate further. The second solution that I want to touch upon is our Power Dividend MidCap Index. Really works very similar to the Power Dividend. Really the differentiating factor is we don't equal weight the sectors, we equal weight the individual stocks. We do have a different algorithm, and we only have one algorithm on this particular asset class. It does behave a little bit differently, so we do have a longer term crossover solution that we apply to it. However, it also has triggered out, and we are again in a defensive position with those assets in short-term treasuries. And then the third solution is our Power Momentum Index, which works a little bit differently. Rather than seeking yield on and reconstituting on an annual basis within each of the respective sectors, we are looking at these sectors on a quarterly basis. And what we're looking at within each sector is the highest Sharpe rated stocks. And again, in layman's terms, what that means is we're looking at the stocks within each sector that carried the best risk-adjusted return over the prior 90 days. So that's how the index is constructed in terms of the underlying holdings. And then, of course, we apply a defensive trigger on each individual sector, again, to mitigate downside risk and to shift out of harm's way. All 10 sectors have triggered out, and we are 100% in short-term treasuries with that solution as well. Next slide, please. So I think a picture tells 1,000 words in terms of how we operate the mechanics of each of our solutions. So what you're seeing here is a visual of our Power Dividend Index, and essentially what we're looking at are trend indicators overlaid onto the underlying index. And basically, where you see the green line cross over the purple line, which we've circled, that is the crossover point which we had a sell trigger. That did occur on March 4th, and at that point we sold out of 50% of the equity positions. We shifted to short-term treasuries. Next slide, please. Similarly, with the MidCap Solution, you'll see that we triggered out a little bit later on March 13th, and we did shift 100% to short-term treasury. So it is a different duration in terms of the signal that we apply, but nonetheless, it has been positioned out of harm's way at this point. Next slide, please. So just touching upon the Power Momentum Index, again, it triggers off of individual sectors, and there can be different environments where we may have areas that get challenged that may drop out of the mix on a sector basis for whatever reason. There's been pockets where energy, as an example, may drop out. It could be utilities in a rising interest rate climate. But once again, in the environment that we've been in over the last 30 plus days, we've had a pretty significant drop in the market in a very quick order. As John mentioned, this is one of the quickest drops from a relative peak down to bear market status that we've seen, looking back a century. So what we have is each sector, as you can see, we triggered out largely between mid-February and the third week in March. Next slide, please. So again, one of the things that I want to point out is, as I mentioned on the S&P 500 index, and I think we'll speak to this because it will give you a general sense of framing it. We have had, like I said, two major bear markets. In the early 2000s, we had the tech wreck. we had a peak to trough drop on the S&P 500 index of in the 50% range neighborhood. And then in 2007, the market peaked down into the low of March of 2009, where we saw a 57% drop. Currently, and just looking at the visual, you'll see that we had a very precipitous drop on the S&P, where on a peak to trough basis, we hit about a 34% drop on the S&P thus far. One of the things that I want to address is looking back at our last two bear market cycles. The market didn't just go straight down, although it kind of feels like we're doing going straight down this time around. The market legged its way down, although relatively quickly versus the rise going up. But looking back at the last two bear market cycles, along the way, you're going to see rallies, in those downtrends. There were two bear market rallies in both of those last bear markets that were in the range of 18 to 24%. So within a bear market, you can see meaningful upticks in the market that can be spikes, that can be pretty dramatic, and that can give you, a violent upswing in the market, albeit the market may still be in a downtrend. So as of this point, we have come off of our lows. Over the last couple of days, we've seen some pretty dramatic movement out of equities. It remains to be seen, again, whether or not this is simply a bear market rally, or perhaps there's more of a quicker V spike on the horizon as we move forward. So time will tell how that progresses. But I think, looking back from a technical perspective, if you look at the chart down to the 2015 and 2016 levels, we really have not seen any meaningful support along the way here from a technical perspective, at least on the S&P, and it really could potentially go down as low as to the 2,100 range from my perspective, again, from a technical perspective. So that, of course, we're in the neighborhood of 2,700 on the S&P down to 2,000 is a pretty meaningful potential drop. So that is a clear possibility. And along the way, we could be seeing, these bear rallies into the downtrend to potentially go down there. On the flip side, as we all know, we're seeing a tremendous amount of stimulus being put forth in the marketplace globally. We've had trillions of dollars put into play to help support the bond market here domestically by the Federal Reserve. We've had fiscal stimulus at this point of $2.2 trillion, which hopefully is getting to folks sooner rather than later. In addition, the Congress is already looking at another potential $1 trillion package here domestically. We've reduced interest rates down to basically almost zero. And then on a global perspective, global central banks are following suit with global stimulus as well. So, we've got, they're throwing the kitchen sink, as they say, at it. And, time will tell how quickly we can move out of this bear, whether it is a, 1 or 2 quarter impact to the economy, which we know it will be, or whether it's more prolonged as we move forward. Next slide, please. So just to touch upon the global tactical allocation suite. So in addition to the rules-based, mechanically driven strategies that I've just gone over, we do also offer core tactical global asset allocation strategies that work a little bit differently, but similarly in terms of the philosophy behind them. All of our solutions are designed to seek strong risk-adjusted returns. So our global tactical suite, we offer 4 different solutions. These strategies are more diversified in the context that they will incorporate within them, in each of them, 3 buckets, if you will. One being global equities, one being global fixed income, and the third bucket being alternatives. And alternatives could be areas such as gold, such as REITs, such as commodities, and potentially MLPs as an example. So We do offer a range of solutions on that front on a risk basis as well. So those are strategies that we also can tilt, and we can either tilt within the three buckets to overweight fixed income away from equities. We can go to cash, and we can also tilt towards commodities, if need be. Next slide, please. So just to give you a sense of our positioning, so the flagship portfolio, which is the Global Tactical Allocation strategy, has again, it's got a target bench, if you will, of 50% global equities, 40% fixed income, and 10% in alts. As you can see, we recently have made some changes within this solution as well, where we have significantly de-risked away from certain parts of the market. As an example, we have reduced our exposure to areas such as high yield bonds. We've reduced our exposures to areas such as emerging market bonds on the fixed income side. We have raised our positioning in cash or cash equivalents. We have raised our positioning in short-term fixed income bond exposure. And we're also favoring on the equity side, both domestically as well as internationally, areas such as quality stocks in both domestic as well as international. And then, of course, we do carry some exposure in areas such as Asia ex-Japan. And as John had mentioned, there are parts of the global economy that are, a little bit ahead of us in dealing with this pandemic crisis. And there are parts of the economy that are picking up, such as China. Manufacturing is getting back in line. So that is where we're positioned currently with this solution. Next slide, please. And then on a global tactical income portfolio, very similarly, we've significantly reduced risk exposure, and again, holding areas such as the quality equity stocks, raised our exposure to cash, keeping our fixed income at a lower duration in terms of our fixed income exposure, and holding areas such as preferred stocks, which do carry a nice, high-paying dividend. So across our entire solution mix here at W.E.Donoghue, we have really taken measures to de-risk across the board, and we will be monitoring the markets very closely daily for potential re-entry points. And we are looking at both scenarios. We've heard some pundits out today talking about the bottom being in place. We're not so certain that the bottom is necessarily in place. There could be some lingering effects to the changes that have taken place with this shutdown. It's clearly going to have impact with certain areas. We all know airlines are basically shut down. We've got restaurants that are being extremely challenged. We've got retail pockets that are being extremely challenged. Eventually, this could lead to further stress in the bond market in certain areas. So, we do believe that this is a time to warrant caution. But at the same time, this too will pass. Next slide, please. So, I would strongly recommend not paying too much attention to the financial channels or too much attention to the latest calculations on the virus. I think it can be a little bit depressing or looking at some of this as it plays through, the death count, et cetera. I think that, as I mentioned, we've all been challenged individually and personally. Obviously, we've seen the pullback in the financial markets. But again, like I've said, we've run through 2 bear market cycles, and this is different. We do believe that this too will pass in a year from now. Although I think we will likely have some, our social environment may change as we move forward here. But I think from a financial perspective, eventually this will settle down. and I think eventually that will be, back on course. But for right now, we are going to be in a defensive position, but that can change as we move forward in the coming weeks, in the coming months. With that, I will entertain, and John will entertain any questions. And I want to thank you all for your time today.
Yeah, Eric here again. So Jeff and John, thank you guys so much for your time, your insight, your expertise. It's always good to get perspective. There's so much information going on out there, and just trying to see the forest through the trees. It's always helpful. So thank you for that. I can't agree enough with you, Jeff. The news cycle, there is so much information out there, but we also get a lot of that same information just being regurgitated. I posted something on our website back on February 24th about this. If any of you want to go check that out, cannot agree more. For everyone on the line, I hope that Jeff and John were able to provide you some clarity, some focus during these times. We did get a few questions that came in during the registration, as well as by email. I'll kind of summarize them. You did touch on them. One thing maybe I'll ask you to add, whoever wants to take it, but generally the question is how long is it going to take for the stock market to recover? And one of the things, if you guys could speak to, is separating the stock market from the economy. You tend to have maybe a difficult time seeing those two as separate. So that's question number one, is how long is it going to take for the stock market to recover? Are we looking at end of the year? Are we looking at 5 years from now? How long is that going to take? And then I'll follow up with another question after that.
Jeff, you want me to take a stab at it? So
yeah,
sure.
We've
already looked at this, Eric, from two different angles. The first, generic, just looking past all recessions and bear markets I just mentioned. Typically, markets recover ahead of the economy almost all the time, and so the question is how much, and what at what rate. And so I kind of compare that to the worst that could happen and did happen in 2008, where essentially you had a complete meltdown of the financial system, and in bank stocks particularly. So bank stocks were the worst performing asset class in that period between September 2008 and March, when TARP, the bailout happened. And so what was interesting is that that bank collapse resulted in over 500 actual bank failures, but the low point of bank stocks occurred in that March timeframe of 2009, where only 8% of all banks that ultimately failed had occurred. The failures had occurred. So if you trace the growth of bank stocks from the March 2009 to 2014, when the final 500, over 500, the 503rd bank failed, you had a roughly 150% return in bank stocks. But at the same time, the news, the recovery news, was getting worse over time. In other words, more and more banks were still failing. However, the market had already discounted that very early on, and that's a really good way to look at it. How price movements often anticipate news and actual recoveries, and that's why I think this is not going to be any different from that. You'll probably hear lots of bad news here and there, pockets of countries being recessions, etc., and even maybe some pickups in viruses in certain places, virus outbreaks in certain places, but that won't probably derail a market recovery once the economies are back open.
Very good.
Yeah,
thank you.
And just to add to that, Eric, just to give you some sense of an example, we probably all can remember as we were in 2018, we saw a pretty significant drop in the market right into Christmas Eve of 2018, and then of course we had a pretty violent pivot, right, in the market, where so that was I would describe that as episodic volatility, where we had about a 20% drop. Well, the time frame to get back to the relative high off of that December 2018 low really didn't occur until about May or so of 2019. So And that was a climate which really was an environment where the Fed was probably tightening too quickly, between raising interest rates and quantitative tightening. And they did a complete pivot in terms of their monetary policy. So that recovered pretty quickly. This is a little bit different, and I think it may take a little bit longer to formulate a bottoming process, just from a technical perspective, but also due to the fact, that for all the economies that are closing globally, we are throwing a tremendous amount of stimulus, and I will say that even though the folks down in DC drive me crazy, they did come together and finally put together a package with some significant dollars. So I think it may take a little bit longer, obviously, than what we saw in the past, 2018-19 dip, and to recover. And time will tell as we move forward. But I will say that the right steps are starting to take place in terms of containment to fiscal and monetary stimulus, from a domestic perspective and a global perspective. But I still think because of the dramatic dip, it's going to take some time, and we're going to see some spikes and some stops and goes probably as we move forward.
Yeah, more volatility ahead. Absolutely. For those of you who watch, I do a summary video regarding the stock market and what's going on out there, and I post it every Monday. You can go to the website if you want to see them. But watching this stock market most recently drop, as Jeff showed us, roughly a third of its value. If you think about it, that all happened prior to any economic news coming out. And so, properly illustrated here, what happens in the stock market is usually forward-looking of what's happening in the economy. So I think that's just an important distinction. I do have another question, a little bit more specific, and kind of looking forward on stocks. The question is, will stocks of companies producing essential products or services be hit as hard as companies such as maybe those that are travel related? Can you speak to what you've seen them do here most recently, and then what you would say the outlook might be?
I'll take a first stab at it, and Jeff, you can answer, because I think some of it is encompassed in the behavior we see in some of the indexes. But so typically, anytime you have a recessive conditions, and of course we're in what we call recessive conditions, even though there's not an official recession, we certainly anticipate to have one that's probably defined that way in the next quarter or so. You see a general outperformance, relative outperformance of a category in the S&P 500 known as consumer staples, which is what you're referring to, Eric, which is the basics. It's toilet paper, it's toothpaste, it's stuff that people have to eat, even whether or not there's a bear market or a recession. So that's almost always the case, and those those will probably do well short term. But again, going back to what we just said, is my suspicion is, since the hardest hit areas, which are leisure and transportation and logistics and things like that, those actually could recover faster just by reopening and starting business again. Because let's think about those sectors specifically. Airlines are having a record for the first time. I think it was the best earnings forecasts in 9 years prior to this. So it won't surprise me that you'll see a really big build up there and then a pretty fast recovery. I think, like always, the market tends to reward, at least in the last, if you look at the last 5 to 7 years, the market tends to reward quality growth, i.e., how can you grow and be consistent. So technology companies particularly have fit into that bill, and so have consumer discretionary, like leisure and most of air travel, which is business and consumer discretionary. So I think you can't make generalizations about it, but my guess is there'll be a shift towards finding growth once the economy opens, and probably in the meantime, you're absolutely right, the consumer stuff will be favored.
Very good. Thank you. I have one more that came in. First, a compliment on the chart, Jeff, that you showed with the crossovers. That provided some good clarity. The question is really related to that, and that is when would you consider changing the rules, whether it's in or out? In regards to right now, it's more about getting back in. But so it sounds like the question, well, the chart provided clarity on how that decision is made, and then just the question is related to when that rule may change.
Yeah, that's a really good question. So we have made some adjustments to particularly to the power dividends solution, where over the last couple of years we've seen, like I mentioned, we had a V spike in 2018 heading into 19, which was a dramatic drop and a very quick rally. And with our intermediate term signals for those points of what I would describe as episodic volatility, meaning we don't have a major recession, economic recession in place driving a bear market. It's other rationale for a deep dive correction. So that being said, we did make an adjustment to the solution to offer a secondary trigger, which has kept us in the market with part of the assets with 50%, and we will be looking to see if that fundamental indicator, as you mentioned, kicks into a defensive posture, which it very well could over the coming weeks, but it's possible that it will not. The other change that we made under the hood within the strategy, given the fact that we were making an adjustment to it anyways, was in our underlying selection process and criteria for selecting individual stocks. One of the things that we heard from advisors and clients is that we buy high dividend paying stocks. However, sometimes you can hold the GE that has a high dividend, but may not necessarily be performing very well. So what we did is we applied a quality filter to that index as well. And that quality filter, we believe will now more than ever will be impactful. As John mentioned, being that we're in this we're in this cycle that we're in currently, this is where you want to hold quality. So we put that into place last June. But as we move forward here, we don't see making any major adjustments, from here with those solutions. And this kind of comes back to my point of, our solutions we offer are, we have a number of different strategies that work either on a rules-based mechanical basis, or we also have the global tactical solutions, which move on a fundamental basis, which are also tactical and can de-risk and move away for different reasons. Although we do, look at technicals as well from a entry and exit point there also. But this is where I would strongly recommend using, multiple strategies and incorporating and blending, our core solutions on the tactical ETF side along with the others, because, this is, an environment where, can the market, drop down and retest the low and take out the low? I would say yes. And can the market also do a V spike here where it, looks similar to a 2019 run? Yes. So we want to have strategies that can encapsulate both types of environments. And I think it's important not only to diversify, clients for in terms of asset classes, but I also think for solutions and disciplines as well. But in terms of, changing the rules, I don't see making any meaningful changes from here as we move forward into hopefully the next rip-roaring bull market.
Very good. Insert the discipline, remove the emotion. That's the message. I love it.
Correct.
Jeff and John, thank you guys so much. We're pushing up to the top of the hour here, so I'm going to wrap us up. I don't see any other questions in here. So again, both of you guys, really appreciate the two of you, the wisdom and the knowledge that you brought to the discussion here today. It's just a wonderful thing to have during such a crazy time. So For everyone else on the line, if any of you want to follow up this call to discuss your unique situations, as Jeff said, to look at your allocations, maybe incorporating some of those global tactical kind of core solutions into your portfolio, or if you just need a sounding board for anything else, please do not hesitate to reach out to our office here. In an effort to keep everyone safe and healthy, we've been doing a lot of virtual meetings over the phone and the computer, so feel free to visit our website. As you know, you can schedule something right on our website, and we'll earmark some time for you. So thank you again for the call today. Everybody taking the time out of your schedules to be here. This will conclude our call, so everyone stay safe. Thank you.
Thank you, Eric.
Thanks, Eric.
Hey, this is Eric again. I want to thank you for taking a few minutes with me here today. Did you find value in today's message? If so, please help me help others and share it. Want more ideas for making the most of your financial future? There are a lot of ways, and I'd love to help. Be sure to subscribe here and then go visit me online at www.erichagan.pro. I hope to see you around.